our presentation today. We're going to start out with James Clore doing a little overview of investing to kind of get everyone on the same page with terminology and that sort of thing. And then Anna will do our usual Angelus investment overview. And then at the end, we'll have some fun examples to kind of bring it all full circle. The other interesting part of today is, as you may have heard, there is a scheduled tsunami warning test. We thought it was at 12, so it'd be good like ending marker for our event, but it's actually apparently between 11 and 12. So please, silence your phones. I'm not sure if they'll still go off or something anyway. But if we do all start getting alerts and hearing warnings, we'll just pause for a moment and notice what that's like and take account in the event of a tsunami and then continue with our event. And lastly, the restrooms are straight out through either of these doors and then right on the opposite side of this wall in the hallway if you need the restroom. So with that, I'm going to go ahead and turn it over to our board chair, Charlie Jordan.
Good morning, everyone. Thank you. I really appreciate everybody being here and everybody that's online. It's exciting because I don't think we've had this room this full in about 4 years. So it's wonderful. It's really wonderful that we're able to be together, and I'm grateful that we were able to do this. I want to tell you, well, first of all, let me just share one more piece. And Rhino would love to be here. She was planning on being here. However, she's come down ill, and so I'm sure you'll see her in other events. And we were appreciated that she didn't want to come in. She needs to stay home and get well. So that's great. I thought I'd tell you guys just a little bit about myself, as I'm the board chair, as Laurel mentioned. We have an amazing board of directors, and it's an honor to serve on that board. Our board takes seriously the responsibility, excuse me, and the duty that we have in governing the funds and the organization here. My background, just so you know, I've been on the board just shy of 10 years, and I've chaired every one of the financial committees, audit, investment, and also finance, and I'm still on the finance committee. So I've been involved in the financial side of the governing for a while. I'm a business owner and entrepreneur, and a local investor, and also a donor. And our family has a fund here as well, as I think many of you do, and many people we know. And for my perspective, there's a monetary position perspective, but there's also more to that when you are managing funds that are people's legacy. There's a piece of your heart, and there's those memories that we hold, and dreams and desires that we hold. And I know I'm not the only one on the board that feels a duty and responsibility to care for that and those funds with that in mind. And so I wanted to just share that with you, so you know that your board members are conscious of that and aware of that. I wanted to also just take a minute to introduce the chair of our investment committee, Dennis Rael. He's our current chair. And I wanted to appreciate Dennis for the time that he spent leading that committee, which was during a time of transition while we were looking, transitioning into this new OCIO situation. Complex work, detailed. It was a heavy lift, and I would just really thank Dennis for his leadership in that and the work that the committee did. And with that, I'd like to introduce to you Dennis, and he can tell you a little bit more about that process.
Thank you, Charlie. So my name is Dennis Rael, and I've been on the board for a little over 5 years. And yeah, like Mary was saying, wow, I kind of like, wait a sec, you're kidding me, it's been that long. And also like Charlie, I'm a local business person and been involved in a variety of organizations and community events in this community, and do have involvement in a scholarship fund, a family scholarship fund for quite a while, which I really appreciate with HAF. And right now, actually, we're right in the midst of, they're sending out all the applications, and I'm started going through all 19 applicants and trying to decide, okay, who are we going to pick this year? But I was not planning on being up here and speaking today. Last night, I got notified about 9 o'clock saying, like, look, Brian, our CEO, was under the weather and couldn't make it, so asked if I could fill in for her. So I said, okay, I'd be more than happy to. And I kind of felt like it was somewhat similar when Charlie mentioned to head up the investment committee. We were in transition, and I got a last minute call, I think, from Mary saying, look, we really need somebody with experience to go ahead. I said, well, I'm not sure I'm the right person, but I'll fill in and do what we can. So it's been great for me to be able to have that, be involved in that transition. And though I've, been aware of Angelus and, had been on numerous presentations with Anna, I'd never get to work with her on a one-on-one scenario. And I need to tell you that as somebody coming in, even though I have, like I said, years of business and community involvement, the level that HAF is operating on, and also the level of our staff, without our staff in particular helping me through navigate this scenario, I felt like I would have been, lost in the woods for sure. So I've been continually become amazed at what they're able to do. So I really want to put a big thank you out to them. But I really look forward to this presentation. Once again, like people before me had said, it's so nice to be able to do this in person and also have more of a hybrid scenario and have folks on Zoom key in. So I'm going to stop right there, and I want to introduce Anna. She's back there, sorry. And to come up and take on this next portion of this. So thank you very much.
Hi, everyone. Good to see you. It's nice to see so many familiar faces. I'm just going to do real quick our disclosures. No, I'm just kidding. We already sort of talked about the agenda. I love James because he's so literal in picking the first topic, which is investments in plain language. And, he couldn't say it better. So he's just going to run through kind of basic stocks, bonds, private equity. And then he'll kick it back to me. We'll talk about the performance review, what happened during the year. As probably everyone knows, it was a very challenging year, 2020. Ever. So I'm going to kind of for a better environment going forward, particularly with the bonds. Yields are much higher, so looking forward, we expect returns to be a lot better in bonds. But also stocks are a lot more attractive because valuations have fallen. And then we'll talk about the three pools: the long-term pool, the medium-term pool, the socially responsible pool. As part of the OCIO search that Charlie and Dennis talked about, we also talked about combining, and some of you all have heard the December presentation where we talked about combining the long-term pool with the socially responsible pool, and the benefits of that and the rationale for that. So we'll talk about that. That's the I guess third major bullet point. The transition occurred January 2023. Another hats off to staff because that was a ton of work, lots of signatures, lots of planning meetings. But that is now in place as of technically March 1st, where everything was funded. So I just want to talk through more highlights of that. We'll keep it high level. There's lots of detail on the managers and et cetera, fees, et cetera, in the books, but we'll keep it high level and then turn it back to Laurel to talk about just some fun examples. So that's the agenda, and then this is also in your book, Who is Anna and Who is the Firm? My name is Anna. I've been at Angelus since our inception in 2001. I'm a partner at the firm, and I worked with our co-founders for a couple of years prior to joining Angelus at the inception. And we have 45 people. We're headquartered in Santa Monica, offices in 3 other locations in the US, and Humboldt Area Foundation is a very important client, so thank you very much for retaining us through that search. So with that, investments in plain language.
I am going to try and drive the camera at the same time as talking, which is probably not going to go that well. Good morning, everyone. My name is James Clore. I'm the Director of Finance and Administration here at the Foundation. I heard on Zoom we're having a little bit of audio issues, and I think it's probably because these microphones are super sensitive, so they'll try to pick up every single sound in the room. Let's see if I can get myself focused a little bit for the people who are joining us. They're on a wild ride right now, so apologies to every person who joined us via Zoom. So, as we've done these presentations a couple times, a topic that's come up is, what are some of the words that you guys are using, right? You throw around concepts like private equity or equities. And so I thought it would be a good opportunity to go through the presentation and try to pick out some words that I thought might need some definition for folks. So as they're reviewing the presentation that Anna gives, it'll hopefully make it a little more clear. Some of these are super simple, like this is investments language like 101 or like 100 level. So, the first one you might look at it and you'll go, really, James? Is that what you're gonna tell us about today? But I still think it'll be useful for us as we're looking at the presentation. So really the first thing that we're going to talk about is a stock exchange, right? One of the things that we talk about is public equities and private equities, and the main distinguishing characteristic between the two is that one is traded on a stock exchange and one is not. So really a stock exchange is just where financial instruments are traded, and those are equities, commodities, and bonds. Super simple, that's a stock exchange. Another topic that comes up often when we're talking about our investments is our asset allocation. This is another simple one. They're the words that mean the words that they mean. So it's the allocation of the assets that we have. It's like the fruits and vegetables and the meat and potatoes that you have on your plate and the different amounts of them that make up the entire portfolio. And what you want to do with your asset allocation is manage your risks and your rewards. And you will build it with different asset classes like equities or fixed income, and cash equivalents. And so you'll see when Anna presents on the long-term pool or the medium-term pool, the different assets that make those up, that's the asset allocation. That's what we're talking about when we talk about that. One thing that always comes up, and we say it all the time, basis points. What are basis points? You might hear it on the radio, right? They're like, oh, the stock market was down 15 points or something like that. And really, one basis point is equal to 1/100th of 1%. And you'll see this pop up when we talk about fees. We'll talk about, the average basis points fees is 45 basis points. So that's really 0.45%. Why we use basis points in investment speak and not just saying the percentages is probably just an opportunity to save a couple words. But basis points comes up often as we're talking about it. Another thing that you might hear, especially when we're talking about private equity or really like the way that we're building our asset allocation, is correlation. And it's really just the concept that it's the degree to which two variables move in relation to one another, right? And so you can have things that are positively correlated, right? So if one thing moves one way, another thing is going to move another way, or negative correlation, where if one thing goes up, another thing goes down. I think historically, there was some kind of negative correlation between equities and bonds, but last year that was not quite true. It was a bad year for everything. And so, some of the historical concepts of what was positively and negatively correlated, I think is probably up for debate going forward. Securities, we might talk about securities in here, and really it's just equity, debt, and hybrids. And we'll talk about what equities are, which is right here. We say public equities all the time. And I feel like sometimes you get lost on like, what are we saying when we say public equities? They're just stocks, right? They're just stocks that are traded on a stock exchange, as we talked about earlier. And it refers to the equity ownership of companies listed on a stock exchange. That's it. That's all we're saying. We're just saying stocks. We will talk about the different public equity strategies that you'll see. And I think this is important to note because you might hear Anna say your growth equity managers under or overperformed in 2022, or your value equity managers over or underperformed in 2022. And I think understanding what these things mean is kind of critical to get a sense of what the asset allocation is doing and why we choose different asset classes. So core stocks, I love this. Core stocks are stocks where companies are neither growth nor value characteristic dominant. So it's not a value stock and it's not a growth stock. It's just a core stock. Value companies appear to be undervalued in the market. Either stocks are traded at a lower value price than their intrinsic value, right? This takes an enormous amount of research, right? This takes you looking at a company and looking at its stock and saying, do I believe that it is worth more than what it is trading at right now, right? And if that's true, then you would characterize that as a value stock. Growth stocks are companies that are considered to have the potential to outperform the overall market over time because of their future earnings growth potential. And correct me if I'm wrong, but most tech stocks are seen as growth stocks, right? So like we used to call it FANG, but I think some people call it MANG now because it's like Meta, Apple, Amazon, Netflix, and Google were like those big tech stocks that we kind of consider as growth stocks. Developed markets, you'll see this in the asset allocation, we'll have stocks that are in emerging markets. You might talk about stocks that are in developed markets, and really it just refers to companies that have that are in countries that have a high standard of living and a well-run stock market. And then likewise, emerging markets refer to companies in countries that are transitioning from the developing phase to the developed. And you might see, sometimes you talk about domestic and non-domestic equities. That's exactly what that means, is equities that are based in the United States and equities that are not based in the United States. And then you will see in here, we'll talk about global equity, which is also exactly what that means. Global equity, equities across the entire globe. I think, these are silly things to say and like say out loud, but I feel like sometimes when you look at a presentation like this, you're like, well, that has to mean something completely different than I thought it meant because they're talking about it in this way. But really the hope of this little presentation is to say, most of these mean what you think they mean. Another big part of the asset allocation that we'll talk about is fixed income. And really it comes down to 3 different categories of fixed income, which are bonds, mortgage-backed securities, and bank loans. And fixed income is kind of like what your mortgage is to a bank, right? You pay a certain fee every month for your mortgage, you have a mortgage payment. That's guaranteed fixed income for the bank to keep in mind. And you can build your portfolio to have different types of fixed income. Bonds are really just debt, right? That have been packaged in a way that they can be traded on the stock market. They have the same kind of fixed income strategy that like your mortgage does for a bank. You create a bond, it has a fixed payout that goes to whoever the bondholder is over a certain amount of time. The weird thing is that we can trade bonds. And so, either you can hold a bond for a long time or you can trade it on the open market. And then when we're thinking about corporate bonds, it's good to note that there's kind of 2 broad categories. There's investment grade and high yield bonds. And that really comes down to the lower the credit rating that the bondholder has. I'll fault this on the tables because they have these bars that come down right where your knees are. So sorry about that, Stuart. The lower the credit rating, the higher the risk, the higher the return. And when we're talking about credit ratings, we're really talking about those like AAA, AA, A, triple B, double B, B. Probably heard these ratings if you've listened to NPR talk about the market and that sort of jazz. I thought this was a really cool image of all the different some of the different kind of fixed income strategies. This came from Angela, so I can take no credit for this. But it shows you your corporate bonds, your bank loans, your government issued debt, and your mortgage-backed securities, and then how all of those flow out. And then somewhere in this bank loans category is also our local lending portfolio, which we'll probably touch on a little bit when we talk about the long-term pool and the long-term mission line pool. That makes up a portion of our fixed income strategy. The last big thing to talk about in my little short time that I have is private equity. And I know it's a topic that probably comes up often when people look at the asset allocation and they go, what do you mean by private equity? What is it? And it's really just an investment strategy that isn't traded on an open public stock exchange, right? So it's finding an equity ownership stake in privately held companies. Again, this is kind of like value and growth stocks. You have to invest a whole ton of research in figuring out what companies you want to invest in. And there's tens of thousands of companies that you can invest in this strategy in this way. One thing that is nice is that they can be less correlated with public markets, right? Like if you get a giant scare across the entire public market, or like, I think it was like 2010 when we saw that like micro flash dip on the market where it plummeted to like 0 because of a computer error. Well, that happened on a public stock exchange. That didn't happen to private equity markets because they're not there on the public stock exchange. So you get a natural bit of diversification and potential bonus in terms of correlation there with these private equity companies. And then you can have the opportunity for higher returns public to comparison to public equities. And so that's one of the big reasons why you see more of the asset allocation moving towards private equities is because Angeles and the foundation believes that there's a potential for higher returns there without a hugely outsized increase in risk. But yeah, and this last point is that it just takes a lot of research to find private equity companies to invest in. I'll close on this, which I think is a cool performance comparison that compares kind of all the concepts that we talked about in terms of like what the long-term expected return, what like the 10-year annualized return and volatility is. If we were doing investments like 110, I would spend a little bit of time talking about Sharpe ratio because I think this is an interesting concept to look at and think about. You can kind of see where these asset classes look at in terms of return and risk. And then I think you'll probably see as we talk about the asset allocation and how we've structured things, why we go with different asset classes and different percentages. So that was quick. I'm definitely over caffeinated this morning. I knew this was going to happen, but it gives us more time to hear from Anna with Angeles Investments about the performance over the last year.
Awesome job. Thank you so much.
So we're going to run through all of this. It's just an executive summary for the kind of major trailing time periods, fourth quarter, 1 year, 3 year, 5 year. We'll mostly spend time on fourth quarter and 1 year. But what I would kind of point out is we've highlighted, whether you were ahead or behind in all of these bullet points. And I'm really happy to say, relative to the total fund benchmarks for the 3 pools, in all of these periods, the portfolios were ahead, with the exception of the socially responsible pool over the 1 year, where there was some underperformance, 140 basis points. But other than that, you kind of just look at the far right, really nice excess returns. These are net of all fees, and that's important because sometimes you might see reporting that is gross of fees, which who knows how much the money managers or the advisors are taking. So these are all net of fees. And again, we'll kind of get through this. The long-term pool is the oldest, the largest, goes back to 2003. So we're almost ready to celebrate our, I guess this year is our 20-year anniversary. Super exciting. And it's 108 million. The socially responsible pool was started in 2019. That's smaller, but still pretty large considering that it was started in 2019 with, I think, $1.4 million in February 2019. And this was established really in response to demand from donors that we would like something that is very explicitly mission aligned. Over that time, there's been a lot of progress and a lot of collaboration with staff, through donor relationships, which is what ultimately led to combining the long-term pool with the socially responsible pool so that all of the assets are mission aligned. And there is a much more intentional focus on the 4 priority areas of the foundation. So we'll talk through that as well. And then the medium-term pool, it's a small pool, $4 million. It is really intended for shorter time horizons. So socially responsible and long-term time horizon. Think, 10 plus years is your time horizon. If you have a shorter time horizon, actually in the investment policy statement, the medium-term pool says 4 time horizons of 3 to 5 years. You never know exactly probably your time horizon for your assets, but shorter term, less risk. While the long-term and the socially responsible pool have very balanced, more oriented towards equity, higher expected returns, medium term is 60% bonds and even a little bit less duration, interest rate sensitivity than the traditional bond market, and then 40% stocks. So Angeles would characterize this as a really conservative portfolio. You can see the returns, and we'll dig through it more. I'm just going to read off the page, and I know you have all this that you can take home as well. So what happened in the quarter, that's the trailing 3 months through December, and what happened in the year, obviously it's quite obvious there's a lot of red here. So again, it comes back to this was really one of the worst environments for stocks, bonds, really across the board we've seen in a very long time, and in the case of bonds, sort of ever. And then James educated us on some of these subcategories. So global equity, that's the full opportunity set. That's US, developed, and non-US. And I'll show you later on, US, developed non-US, so that's Japan and Europe, and emerging markets, which is about 11% of the portfolio. And then you can see US equity, and then within US equity, the growth, value, and small cap, and then non-US, developed, Japan and Europe. Emerging markets, you can see they used to call it the BRIC countries, Brazil, Russia, India, China. China's over 30% of that portfolio now. So when I talk through the portfolio, what I will highlight, and I know that probably a lot of you want to glaze over because growth value, I mean, James told us what it is. But the growth value really does sort of explain what happened in your portfolio when I talk about why did you outperform, why did you underperform. And that kind of comes down to both the 3 months and the year. So the growth index returned 2% during the final quarter. The value index was 10% higher. So those, and again, kind of what is a value stock? You can think of it as banks, energy, utilities, slow growing, cheap, boring kind of companies. Growth stocks, I think the FANG or the MANG, whatever, was a great example. Those, like Tesla, for example, very positioned for high growth, not cheap, and not a lot of profitability now, but people are buying it. So that's kind of the main highlight of sort of what happened in the quarter and the year. For the year, these growth stocks, these growth-oriented stocks, were 21% lower than value stocks. So that's a really big difference that we don't see that big of a difference in a traditional market. And so your growth managers, and that would be mostly American funds when we talk about the long-term pool, they underperformed. Whereas your value managers, they offset that underperformance. And that would be like DFA when we talk about the managers. Commodities was the one area that wasn't negative for the year. You don't have any dedicated exposure to commodities. We've never liked commodities as an asset class. They're more volatile than equities, and over time, there has not been really much return. You can actually see that in the 10-year return, where global equity returned almost 8%. That's annualized on average over the last 10 years. Commodities were negative. So not having an allocation to commodities long-term has been the right thing, but certainly, last year was a challenging or a good year for commodities. And then I talked about high yield, and James educated us on that. So I like this little graphic because it shows that stocks and bonds fell together for only the 7th time in the last 150 years. And it's really due to rising inflation and slowing economic growth. So it's pretty obvious what happened in 2022. So the way to read this, anything above this line means that the S&P was in positive territory. Anything below, S&P was negative. And then the Treasury, US Treasury, anything to the right, the Treasury was positive. Anything to the left, US Treasury calendar year return was negative. So if you're in this bottom left quadrant, that means stocks and bonds underperformed at the same time. Only happened 7 times in the last 150 years. So again, last year was brutal. I think I'll just skip this in the interest of time. The prior slide really speaks to markets are volatile. There's going to be intra-year losses. Every year you see negative intra-year losses. But over time, markets go up. And even the really big blip we just saw in 2022 is a blip when you look at this very long-term time horizon. And then staying invested is so important. Timing the market is impossible. It really is. This, I think, is a nice way of highlighting that. Over the last 20 years, if you just stayed invested in the S&P 500, didn't open your statement and just, didn't try to time the market, your annualized return was 10% a year, which is very high, just to
get 10% a year for the last 20 years. There's years where it goes down. I mean, I think it was 2 slides here. In 2008, the S&P 500 was down 38%. So that's, capturing all that volatility. But over time, you're rewarded if you just leave your portfolio invested. How do you just miss the 10 best days over that 20 years? And that's a lot of days. I mean, there's 250 trading days in the year, times 20. You miss 10 of them, your returns were almost half. So no one can time the market. Even, hedge fund managers that are paid millions and millions of dollars can't time the market. So, and we can't time the market. And then interest rates, we talked about fixed income having such a challenging year. The reason why is really, well, going back to 1981, when some of you may remember your mortgage in the 80s were, in this range, in the 15–16% range. We were at that point really kind of fighting inflation at that point, and the Federal Reserve jacked up interest rates so majorly to fight inflation as we're doing now. And over the last 40 years, we've been on the downside. Interest rates have come down as inflation has come down and been stable. So over the last 40 years, with interest rates going down, that simultaneously means prices are going up. So that's been an outstanding environment for fixed income until basically, 2 years ago, where the 10-year yield, which is that blue line, hit 0.5%. So if you were going to buy and hold a treasury bond, you were going to get 50 basis points, to speak to the term we learned today, over the next 10 years. Meanwhile, inflation is probably around 2. This was before the big spike up in the last year. That's not a very good investment, right? And so what happened is we had this unanticipated rush of inflation, where inflation year over year through June of 2022 got over 9%. Now the Fed says, okay, we're late to this. We've got to ramp up interest rates. We've got to get inflation under control, because really the consequences of not addressing inflation are worse than hiking up interest rates, putting, maybe a soft landing, but maybe a recession, but then at least we take care of inflation and life can kind of go on. So as a result, that's been increasing the short-term federal funds reserve, Fed funds rate, and that has also lifted the 10-year. And as we're experiencing that increase in rates, bond prices are falling. So we saw that negative 13% return. So that's a little highlight. Kind of covered all of these. We'll just get back into performance. So let me just get a little time check. I kind of highlighted all this. I'm going to just move ahead. The purpose of the long-term pool, James actually helped me, kind of did this slide and really pulled it from the investment policy statement, which you all don't see. But there's a very detailed investment policy statement, which is really the blueprint of how the governance, the asset allocation, the policy, the risk tolerance, the roles and responsibilities. This is a little excerpt from that. And it does highlight the 5% of assets may be used for local impact investments. That's actually been a really great area. It's small, it's 2% of assets. Because it's been so successful, there's been about 7 million lent through that program, and a lot of it's been paid back. So it's just been smaller. I think there is emphasis to invest more resources and ideally get that to 5% of the long-term mission-aligned pool, which is now that combined portfolio. So now it's about 2%, and it started in 2014. And I'll show you how well it's done relative to the Barclays aggregate. Here's just a visual of the long-term assets. You started in 2004 with around $30 million and grown that through donations, inflows, as well as really solid returns from having that balanced long-term portfolio. And then asset allocation, we'll talk a little more about this. This is showing the dark blue, the HAF current policy, which is the current policy for the long-term mission-aligned pool, since that was already approved. That was approved at the end of 2020. So we hadn't fully rebalanced to that until early 2023. But it's still helpful, I think, to look, how does that policy once we get, sorry, I'm not doing the Zoom. Once we get to the 15% in private equity, 5% in private credit, we're actually at 5%. But the private real assets and the private equity, that's going to take some time just because of the nature of private equity and investing in private companies, wanting to invest over market cycles. To have what we call vintage year diversification. We probably won't be at those levels of private equity and private real assets for probably 6-ish years, could be 5 to 7. So you'll see we're underweight that, and we'll be overweight global equity as a source of funds. So when we start getting capital calls, as those private companies, private managers identify private companies to buy, there'll be a capital call, we'll take it from global equity. So not huge differences relative to all community foundations or similarly sized community foundations, a little bit less in fixed income, more in private equity, no in hedge funds. This is absolute returns, also known as hedge funds. So just reflecting, it's a growth-oriented portfolio. It's a high return hurdle. We're seeking to put together a portfolio that can generate a return of 8.75 so that we have the ability to preserve the purchasing power of the corpus. And that's after factoring in 4.5% spending, 2.5% inflation over time. Inflation is going to be higher in the near term, but really over the next 10 years, Angeles believes it'll be more in line with 2.5%, and then an administrative fee of 1.75. So that's what we're sort of solving for when we are talking with the board and the investment committee about what the right policy is how do we put together a balanced portfolio that has a high probability of meeting that return objective. And then this is some of the reporting that the board and the investment committee get. We meet quarterly with the investment committee, generally sometimes 3 times a year. And there's a couple duplicates here. American funds, A, and then F2 and 3. These are all the same. There's different share classes for various reasons, but they're all the same. And then American funds, new perspective. American funds growth, this is international growth oriented. So I talked about growth being out of favor. And you can see that over the last year, that American funds, Euro Pacific growth, underperformed the broad market, the international equity market, by about 7%. So that reflects it was a hard environment for growth. American funds, new perspective, there's 2 share classes. You can't see the 1 year because we converted into the lower price share class, but that also underperformed. I guess you can see it in F3, 25.6 versus 18.4. So again, growth-oriented hurt. DFA, on the other hand, which had been lagging because value had been out of favor for many years, DFA added value and provided downside protection. And then the Vanguard S&P 500, right in line, very low fee, just expected to get the S&P 500 index. Total private equity, 3%, as I mentioned, it's not anywhere near the 15% target because we're still so new to it. But it did because it's lagged and because it's not mark to market exactly, it did provide good diversification. It was up 14% in the year. And then total private real assets, too small, and it's not really mature enough to even show returns. Private credit, this is about 5.7% of assets. This was a very good part of the portfolio. This is investing in private debt, so high yield, and this part of the portfolio, total fixed income, this is all public debt that you can, not necessarily exchanges, but you can, with brokers, trade your fixed income instruments. Private credit is private lending. It could be some distress, more credit, lower risk, but higher return. And so you're locking up your money for a little bit longer than you are with, your other asset classes. Not quite as long as private equity, but with the idea that that gives the manager more flexibility to do more interesting things with sort of legal background, investment prowess, research, et cetera. And that part of the portfolio only fell 1.4%. So that was really good that we diversified into that in 2020. It was a new asset class. Fixed income, all of the managers have been very stable. We've had this roster for a long time. You can see the same
periods, and they've all outperformed nicely. The community loans I mentioned, it's a small part of the portfolio, but for the year, because it doesn't have the same interest rate sensitivity as overall Barclays aggregate or Bloomberg aggregate, which is the main investment grade fixed income bond index, it actually rose 4.8% in the last year, whereas the rest of the managers, definitely fell into negative territory. And you can see over that long term, since inception period, the community loans returned 4.8%, whereas if you would have just held the index fund for bonds, it would have been 0.8. So you outperformed by 4%. So the community loans have been awesome. And I think, doing more there is really a good diversifier and truly the sort of highest mission alignment that you can get for your community. We show, speaking to James's, different parts of the market, this is really the way you can slice up the global equity portfolio. And if you have big tilts, that would be a source of potential outperformance or potential underperformance. The portfolio really doesn't have big tilts, and that's really been by design. We want to let the managers outperform and keep everything pretty close to the benchmark. There's a little bit of a growth bias because a little bit more in American funds, but really in line with the benchmark. And so that little tiny growth bias, led to some of the underperformance that we talked about. But overall, just a very balanced portfolio, not a lot of bets relative to the benchmark. And then fixed income, we also, again, we talk with the investment committee and the board regularly about these positionings. And I would just kind of highlight, so your fixed income composite, not including the community loans, has a yield to maturity of 5.7%. So if there were no defaults, which there will be some defaults, but if there were no defaults and you held that portfolio to maturity, just all the bonds held to maturity and rolled off, your annual return would be 5.7%. The average maturity is 6 years. Had you just held the Barclays, I keep saying the Barclays because that used to be called Barclays, the Bloomberg aggregate, your yield to maturity would be about 1% lower, but yet you're also having to hold it longer maturity. So we like this portfolio a lot, less interest rate risk. So if we were to revisit another environment where interest rates go up a bunch, you have better protection against that, but yet you also have a higher yield. So you're able to clip a higher coupon over time, while still having a very safe, it's A-rated, the fixed composite's A-rated, so very high quality portfolio. And then fees, I mentioned at the outset, fees are so important. If you invest a lot of the portfolio in high fee active managers that they don't outperform, that you could have a lot of underperformance overall. So we spend a lot of time making sure we're in the lowest fee strategies, managers, and balancing that. So overall, the fees are really competitive, and we'll show you that. Medium-term pool, I talked about that. If there's anything new here, maybe just the medium-term pool is not available for endowed funds. And that I think I hit on a lot of these. You can see historical data. Here, this portfolio also has generated excess returns over all time periods. And the equity part of the portfolio, the public equity part of the portfolio, is all indexed. So we're not expecting any excess return from there. The fixed income part of the portfolio does have some active management. It's also a heavy amount of passive with the Vanguard Total Bond Index. The DFA short-term quality, that's pretty index-like. And then the PIMCO Income Fund, which is an opportunistic fixed income strategy, that's added a ton of value over time. And that's really one of the main areas why, when you look at the overall medium-term pool, the excess returns have been good over time, is really due to the 23% in that active bond strategy. Low fees, because such a heavy allocation to passive, the fees are 18 basis points, the weighted average expense ratio. And then the socially responsible pool, we talked about this, really the focus is on companies with high sustainability ratings, economic development, renewable resources, and good governance. We've really taken that emphasis and put it for the full combined long-term mission-aligned pool. This is, I'm just gonna zip through here. So here's the same sort of manager roster. It's 100% actively managed because, of course, if you just have 100%, or if you have some passive, you're not getting any of that ESG or diversity. So it's 100% actively managed, yet still a very attractive fee, which I'll show you. We've utilized some of the managers. We have some DFA strategies, which we have DFA in the long-term pool. These are sustainable focus, so they're leaning towards companies that have higher sustainability ratings. Pax World, it's a mutual fund that really focuses on environmental, climate change solutions in this area. And then Vanguard, Bailey Gifford, Global Positive Change. We've been invested in this strategy since it started in 2019, but Vanguard actually moved Bailey Gifford, which is an Edinburgh-based manager that we've invested with for 15 years, like a lot. Vanguard said, hey, Bailey Gifford, we'll take over your mutual fund, we'll reduce the fee, and you'll just be our sub-advisor. So that happened, but as part of that exchange to the lower fee, I think I have the bullet point, the expense ratio went from 72 basis points to 59 by that transition, so that Bailey Gifford no longer has to deal with running a mutual fund, which can be a lot of work for a manager. Now Vanguard has a lot of economies of scale. Vanguard's one of the biggest money managers in the world. So you don't see the longer term return. You do see they had a good 3-month period, but the Bailey Gifford Positive Change had a very bad 1 year because it's very growth oriented. Yet it was also your best manager over that 2019 full inception period. So when we talk about the 1 year underperforming, we can really point to the Bailey Gifford. You can't see it because we had to transition into the Vanguard, but longer term, the 3 year and the since inception, well ahead of the total policy level. And then Tia Craft's Core Impact Bond. This is our favorite core impact bond strategy, really low risk. It's going to return in line with the benchmark. Plus, it underperformed for the year because they just had more exposure to corporate, which was a negative, but we still really like that strategy a lot. And it's low cost. So the expense ratio for the SRI is 39 basis points. That's right here. I don't think I highlighted this slide for the long-term pool, but that was 40 basis points. It was a little bit less than the long-term pool and very low compared to diversified long-term portfolios. And then we show this. It's sort of similar, no sort of active bets in the portfolio. Same thing, you're going to have a yield premium with a little bit less duration. And then the long-term mission aligned pool. So asset allocation, we spent a lot of time over 2022 talking about the benefits of combining the long-term pool, the socially responsible pool. And you can see the asset allocation here. These are the targets. So we were targeting 10% to private equity for the long-term pool, 5% to private credit, and no allocation to private real assets. And then you can see the fixed income. Socially responsible pool, very straightforward, 80-20. We didn't want to add any privates because it was such a small pool. But by putting them together and having a larger asset base and kind of taking a clean slate, we also have a new vehicle now where clients can access private real assets in a diversified way, whereas we didn't have that previously. We can now consider this new asset class and think of that as private real estate mostly. It could be a little bit of other real asset things like infrastructure or power. It will not be oil and gas. Could be some renewables, things like that, but it will be private. It's private instead of private equity, it would be like private properties with similar returns as private equity. So this new long-term mission aligned pool has a higher expected return. We're now at 7.5%, and this is our net of fee long-term expected returns for the portfolio over the next 10 years. The expected risk is basically the same. So we're not really taking any more risk, but by moving to have more in privates over time, again, it'll take us probably 6 or so years to get to these targets, we're able to have a better Sharpe ratio, which is your risk adjusted return. You want this line to be as high as possible, because that means you're getting a higher unit of return for the same level of risk. And then we talk about illiquid and less liquid. It's a little bit less liquid than both pools, but still very balanced. And if you think of the average foundation, it's still way more liquid than typical, large private foundations and even some community foundations. And then, so this is, we talked about the managers for the long-term pool at the top. We assess that the long-term pool is about 53% mission aligned. That's when we look at the active managers and what ESG integration are they doing? What shareholder engagement are they doing? Are they aligned in some way? And we assess that about 53% of the assets are aligned. 100%, of course, we're socially responsible. That's no surprise. And then when we put it together into the new long-term mission aligned pool, 100%, of course, is aligned. And then I'd also highlight the fee. So I talked about 40 basis points for long-term, 39 for socially responsible. The long-term mission aligned pool is even lower. So we're, higher return, same risk, lower fees, 100% mission alignment. We're really excited about how it all comes together. And then another benefit is everybody, not just the long-term pool, gets access to private equity and the community loans, but now all of the long-term assets now can benefit from the higher alignment of community loans, really the great returns from the community loans. And I'd say the same thing, the higher alignment for private equity, we're going to have a lot of alignment in that part of the portfolio, as well as certainly higher returns, which is the main reason for it.
So far, and you may get to it, I don't see anything in this aligned pool that addresses the level of socially responsible funds.
So it's kind of a terminology thing. I think you can think of responsible investing, ESG, socially responsible investing is all kind of the same thing. They may mean something a little different to different people. Socially responsible investing goes back to probably the 70s, where what that meant at that time was really exclusions. So that meant maybe not leaning to the positive tilts of, good, diverse boards or companies that are being proactive on climate change. Really, the old school SRI or socially responsible was no tobacco, no private prisons, any of the kind of typical, no firearms. And then, Catholics had their own list of prohibitions. So it will vary based on the strategy. Certain strategies like AKO, Bailey Gifford, Tia Craft, Impacts World, they will have certain exclusions in their portfolio that basically follow those common ones. But it's kind of just a terminology thing. I would say 100% of the portfolio is aligned with social responsibility because of that. It's just, we kind of use different terminology.
So we're not giving up what was in that socially responsible level?
No, we are increasing it. Because of the ability to use the community loans, the ability for private equity to be more active on that. And we basically carried over several of the strategies from the socially responsible pool. So the DFA strategies, the sustainable strategies, you'll see that on the right-hand side. Pax Global, it also made it over to the long-term pool. American Funds View Perspective, we kept because it has a very high alignment. And we like the active management, the managers, and then we added and then we kept Bailey Gifford, which was from the socially responsible pool. We added AKO and Aperio. AKO is an active manager that is very socially responsible, will have those prohibitions of common sin stocks. And Aperio is basically, you can think of that as very low cost. It's going to be basically passive management. We're not really looking for a lot of excess return from that portfolio. It's going to lean towards racial justice and diversity. So it's going to lean towards companies that have more diverse boards and employees, and underweight those that are less diverse. So in alignment with the mission priorities of the foundation. And that's a custom separate account portfolio, very customized to the foundation's mission, as well as provide opportunity for shareholder engagement. So, yeah.
I think, if I'm correct, we've not only increased the portfolio that has no sin stocks, but increased positive
Yep.
action forward. I think
Absolutely.
that's, to me, the easiest way to
That's
understand it.
Yeah, and you've reduced costs and
Yeah.
you've increased expected returns.
So not just being negative, but being positive towards
Well,
our
yeah, the
missions.
socially responsible did have positive tilts, like the
Yeah.
data-based sustainability, it overweighted companies that are more focused on climate change solutions, lower emissions. So you still had the positive change here, but now 100% of your assets are both getting, leaning in and having that positive tilt. And many of the strategies have the negative screens, not all necessarily, but most do. Like American funds do perspectives, it doesn't say in the prospectus, we will never own a tobacco or firearm. I don't think they ever have, because it's not really kind of within their strategy, but there's not that sort of assurance from the prospectus, yeah.
There's a wedge missing on the.
Oh, you're right, what is that?
That should be vote ETF, right?
Thank you, yeah, that's vote ETF, which you can think of that like the S&P 500. So very low fee, it's a 5 basis point fee, which is sort of rock bottom fee for passive. You're basically gonna get the return of the S&P 500. It's actually a little bit different benchmark because like the Morningstar large cap, because they don't wanna pay the licensing fees just to keep very rock bottom. And what you're getting that you're not getting from the Vanguard is shareholder engagement. So they have, I think, 3, I don't want to misstate, they have 3 emphasis. This is engine number 1, transform 500 ETF vote. You can buy it. You're going to get the return of the index, and then they are going to actively engage corporate boards and managements on these 3 topics: diversity and inclusion, climate change, labor practices, and employee engagement. And they're going to maybe do 5 a year. It's not like every single company in the S&P 500. That's not realistic. They're going to pick 5 companies, and you may read about it. They had a big campaign with ExxonMobil to get them to add board members that have more experience in renewable investing, which was a big news article. So good catch. I'm not sure how we lost vote, but yeah, vote, that would be the other thing. So we're balancing passive with the Aperio ESG, with the vote that is nameless, as well as active managers that are going to be really forward on the ESG mission alignment and keeping fees really low, 37 basis points. To have, part of the portfolio invested in privates, that's really, really a low fee and nice diversification. And then these are sort of the main, this is another excerpt from the investment policy statement. These are the main strategies that the foundation will be using with mission alignment. And then we just sort of map it to which managers fall under that category. So you can see here, we've talked about most of these. ESG, it can include the negative screens, so that's predatory lending, private prisons, tobacco, firearms, and positive tilts. Diversity, that could be investing in managers and funds with diverse ownership, or investment teams are very diverse, or in the case of private equity, it could be a diverse manager investing in diverse entrepreneurs. So there's many different levels of this. It could also be the Aperio public equity strategy that's tilting towards public companies that are more diverse. Shareholder engagement, just one little footnote on the shareholder engagement, that's a separate, so that's going to mostly be through Aperio. We cannot vote, the SEC has a rule that you cannot vote proxies or file shareholder resolutions until you've held a stock for at least a year. So once that portfolio, which was funded in January, has been held a year, then we'll be able to start reporting to you all at the board, here's the proxies that we filed, here's the resolutions that we participated in. And clients that have done that, they get really, really excited about seeing that influence in that way. And then you have engine number 1 doing it as well, and we'll be able to start reporting on different campaigns that they've done. And then impact investing, that's going to mostly be community loans. That's kind of the most impact, that's in your community, that's the most impact we can probably get for any unit of capital. But we will also be opportunistically investing in impact funds. There's a couple of impact funds that just recently went into the Angeles Real Asset Fund that we highlighted, and there's detail in the deck if you're interested. So that'll be mostly through the private portfolio and through the community loans portfolio. And then this colorful schematic really takes the 4 mission priorities that the foundation established. So these are words, sort of first row, these are words from the foundation. And then Angeles took those and kind of mapped them to what investment themes would fall under that. And this is going to be a work in progress. So next year it might look a little different. You know, these kind of things are never perfect the first time. So they'll be evolved and, you know, with input from staff. But, you know, racial equity, how could that translate to an investment theme by investing in minority or gender lens, investing in diverse managers, companies. And then what we've done is we've sort of gone through the long-term mission aligned portfolio and assessed the alignment. Is it low, kind of above average, or like best in class? And then we've summarized it here. So really high alignment across all of these 4 major things. And this kind of thing is super helpful for Angeles to know, not just, and you guys are way above where most mission aligned investors and foundations want to be. Most of my clients that are, you know, interested in this say, yeah, we want to be ESG, but there's nothing detailed. Like, this is awesome for us to be able to have this understanding of exactly where your mission priorities are, so we can be really more intentional in the managers that we bring to you. So hats off to the foundation, because this is, you know, light years ahead of where I think most mission aligned foundations and endowments are. And then kind of where do those come up with? There's pages and pages that support sort of our assessments. And these will evolve over time, but we sort of align, you know, not every strategy other than community loans, because, you know, they're so highly aligned, but not every strategy is going to necessarily fit all 4. Some may fit only 1, as you can see some of these. And that's okay. You know, we can't let the perfect be the enemy of the good. Like, we want to just be as aligned as we can, fully diversified, and put together a really nice balanced portfolio that we think can outperform as well. Because we don't want to say, oh, we're mission aligned and we're probably going to underperform by 1% every year. No, you know, we want to still have a very solid institutional portfolio that we believe will outperform and help you retain the purchasing power of your corpus. So the rest is kind of detailed. I already got pretty detailed, more than I thought I would. So I'll stop there, or should I pass over to Laurel?
Rick, did you have a question before we?
Yeah, I'm sorry.
Can you give us an example of community loans?
Yes, James? I sure can.
Yeah, so, you know, one community loan that we participated with was with the Hupa tribe to purchase land that was adjacent to their tribal lands. You know, they have a fairly robust budget in terms of like how much they run through their organization every year, but the amount of assets that they have available for, you know, independent expenditures that aren't, you know, exactly related to their program funding streams was fairly limited. So we partnered with them to do a community loan so that they could purchase that land that abutted their tribal reservation. You know, in the past, we've worked with Open Door, I think on the Tid Street location, to be able to give them access to funding to like purchase the land and then get the construction costs going, so that then when they actually opened the clinic, they could then refinance and get out of the loan, which was, you know, not great for us because that closed that loan out, but great for them because they had access to the funding at the beginning. And so, you know, we have some great program officers who've just started with the foundation recently, who are going to be working with community partners to try to drum up more opportunities for us. But really, we look at our 4 goal areas, right, of thriving youth and families, just economic development, healthy ecosystems and environment, and racial equity. And we're trying to find loans that could kind of fit those and then go forward with it. So,
And are those only with municipalities or nonprofit 501c3s and such?
that's the preference. So the preference is to nonprofits because we're a nonprofit. And so if anything goes frighteningly south, it can turn into a grant. It hasn't happened. We haven't had any defaults or anything like that. But there is an opportunity to work with businesses. You know, we usually just work through, you know, a municipality. We almost always work with AEDC, who likes to be called AEDC, not necessarily Arcata Economic Development Corporation, because they serve many regions And then we work with REDEC as well, the Redwood Regional Economic Development Commission. So, they can bring loans to us and we can participate with them. But yeah.
Great, thank you.
Cool.
We have just 4 more slides and then we'll do the rest of the questions, unless they're about the.
Quick question, and so my level of ignorance, by the nature of my question, how does the Humboldt Area Foundation rate of return compared to the market index?
When you say market, do you mean like S&P 500?
Yeah.
Well, so the Humboldt Area Foundation is diversified, only, this is mission aligned pool. Oh, yeah, that is it, sorry, my bad. So the long-term, now it says mission aligned pool because our system had already combined it. This is still the long-term pool, pre-conversion. Going back almost 20 years, it's returned 6.1%. So do you see this number right here? And then had you just invested in the mixture of the assets without any active management, it would have been 5.9%. That's the Humboldt long-term benchmark. Had you been invested in the S&P, I don't have the exact number. It's probably higher because S&P is a lot more risk than the overall balanced portfolio. Yeah, this top row is going to be the long-term pool relative to the policy benchmark for all those time periods.
We've made it to almost the end, and we're just gonna close out by looking at a few of our actual funds here at the foundation. So James provided kind of the high-level overview around language. Anna from Angelus, because Angela got into the details. And so now we're gonna look at what does this actually mean for our funds and our community? What does it look like over time in practice? So first, we have here a couple of organizational funds, and these are actual funds at the foundation with their current actual balances that we've just anonymized for the purpose of these examples. So they've both been around for 25 or more years, established in the mid to late 90s, and they are organizational funds. So those funds that nonprofits in our community establish with us to invest their endowments, their reserves. We have about 120 of those funds here at the foundation. And so in these examples, you can see both organizations deposited into their funds over that period of more than 20 years. Neither of them has withdrawn anything from their funds so far. Different organizations do it differently. Some annually request a disbursement from their fund, others as needed, and some others keep it as like a true endowment or reserve fund and have, for emergencies. And then looking at the current balances, we can see that both of them have seen some really nice growth over time. And so that's just to say that this is one way that we can use this tool of investing assets to help our nonprofit partners grow their resources. And so now, because this has been invested over time, they have these additional funds, in their reserves and their stability that they wouldn't have had if they had just left it in a savings account. And so looking into some of our donor funds, the Bill and Juanita Thompson Fund for Community is a fund that was established in 2006. And Bill and Juanita were both business people in Humboldt County. They were realtors, and they were actually involved in the development of a lot of large projects, including the Valley West area. And so in 2006, when Juanita passed away, Bill established a donor advised fund here at the foundation, and he contributed some gifts of appreciated stock to that fund. And throughout the rest of his lifetime, he made then grants from that fund to the organizations that he was involved with and cared about in the community. And then he did that until his passing, and in their estate plans, the Thompsons had listed 7 organizations that they wanted to support. And then with us, they had specified in their fund agreement that upon Bill's passing, their expendable donor advised fund would convert into an endowed designated fund. And so now that fund has continued to support those 7 organizations. Their estate gift went into that fund, and now it supports those organizations to this day, many years after their passing. So In 2023, this year, that will look like $240,000 going out to those 7 organizations that they cared about during their lifetimes. This one, I realized I made a mistake on the name. I invented that Johnson part. It's actually just called the Lillian and John Norman Henderson Memorial Fund. And Lillian and John were married in 1934. Lillian was a Humboldt Standard reporter, and John was the undersheriff. They both were avid readers and were involved in many different community organizations. John unfortunately passed away in 1946. And then Lillian went and got her master's degree in library science at Berkeley. And she then came back and taught in Eureka City schools for many years. She also volunteered with many different local organizations, including the library, until she was well into her 90s. And she, during her lifetime, was becoming concerned about what she viewed as diminishing funds available to support our local library. And so she decided to leave a majority of her estate to establish this fund to support the Humboldt County Library. And so when she passed, that gift came into the foundation. We established this fund, and it still benefits the library to this day and continues her passion for books and the community that she lived in. She passed away at 100 years old, so the community that she lived in for 100 years and supported. And then the Grace and Jim Brown Memorial Fund, I wanted to include just as a different type. It's a scholarship fund, and it's a little bit smaller of a fund. So I just wanted to make sure to include that, you know, this isn't only very large funds that we're talking about with this. It can be any size fund. And this one is also different because it was established by the people who cared about Grace and Jim Brown. They were residents of our community. Jim came from Northern Ireland at the age of 21. He was a minister, and he also went to law school. So he volunteered with the Public Defender's Office in the Superior Court of California. And Grace, during their marriage, raised their 3 daughters. And then once her daughters graduated from college, she went and fulfilled her own educational goals and got an associate's degree from College of the Redwoods and then a bachelor's degree from HSU. And she then went on to work as a caseworker for the Redwood Coast Regional Center for 10 years. And so when Jim passed away, this fund was established and people made gifts in his memory to this fund. And then when Grace passed away several years later, additional gifts came in her memory. And so this one is nice just to see how it's made up of 111 smaller donations from the people that cared about them. And it's not a huge fund, but it still over time has given out over $16,000 in scholarships to students in our community, and it still has its balance of $23,000, so we'll continue to do that. So we just wanted to share these several funds among the many that we had. I had fun reading through all of them and learning about these people from our community and what they set up and what is still going on because of them through these funds, and made possible because we have Anna and James and our finance committee and everyone investing in these assets and making it possible for it to continue on and carry on these legacies over time or strengthen our nonprofit partners. So made it to the end of our presentation, and we might be able to get through our Q&A before the tsunami warning as well. So we'll open it up now to any questions that anyone has. And for the folks online, if you want to just put your questions in the chat, we'll be able to read them out and answer any online questions as well. And the questions can be for any of us, James, Anna.
Yeah. Calling for James. It says the return objective 8.75%, 4.5% when it's spending, 5 to inflation, 0.7 to 0.75 to administration. And the average obviously I think was what, 6.1, and the target's 7.2. How does that affect the short-term spending policy?
Yeah, so the spending, it's a really good question because it's a topic that we're actually discussing this year and we pay attention to a lot. So the spending policy is calculated on 16 trailing quarters, right? So we look back at 4 years of the fund balance and then calculate the spending policy based on that. And so that smooths some of the ups and downs that happen in the market, which helps our entities that receive grants from these funds, right? So what's our core basis responsibility as a community foundation? To support the community, right? Our equally important basis as a community foundation is to protect the assets that are here as endowed funds. And so, you know, when we think about the TSP value, that 4.5% that we use. We have to look at what are expected future returns, but then also what are some of the past returns that we picked up, right? So in 2008, we dropped the total spending policy to 4%, kind of as a reaction to the financial crisis that happened. And then in 2016 or so, we raised it back to 4.5%, right? Because looking at the past returns and future returns, we could see that there was some flexibility in there. And then for the COVID-19 pandemic, we raised it to 5%, right? Because we knew that the community needed those assets at the time. And so we made that decision. And then the next year we dropped it to 4.5. I think what we're seeing as a committee now and what we're going to be talking about is, does it make sense and is it prudent to maybe drop that a little bit from maybe 4.5 to 4.25 or to 4%, and to think about what that means for the community. There's this law that was passed, I don't know, early 2000s of MIFA, right? Which is the Uniform Prudent Management of Invested Financial Assets, which basically says that you are immediately considered imprudent if your total expenditures, not counting inflation, because they don't include that in those calculations, is over 7%. So right now at our spending policy plus our fees, we're at like 6.25%. So we're still considered prudent via UPMIFA, but we still have a responsibility to look at our future returns and what those are. So long way to say, it's a conversation we're having right now to see if those future returns are something that we need to address and change. If it's interesting, some really good years fell off of these reports. Our historic return, if you looked like 2 or 3 years ago, was like 10%. So kind of made up for some of those years where we weren't returning as much. And so we could kind of rationalize that 4.5% spending policy with the understanding that we weren't necessarily going to make that up right now. But it's definitely a topic that we're considering. Sarah Melsa, you're on Finance Committee with me. Do you have anything to add?
Yeah, I think you really covered it, even looking at last year's annual report and looking at the 10-year look back, it was 10% return. So, that was a very robust. So even at that point, when Finance Committee and the board met, the look forward was 7%, something like that. But the look back was 10%. So, taking those 2 data points. And I think, this year, we look at this every year as part of our budget process and by policy. This year we'll do that same analysis. When we look back in, what is the look forward looking at? And, what's the prudent thing to do for the next year? And once again, these changes are looked at every year.
Any other questions? Patrick?
Question for Anna. The investment folklore is an inverted yield curve, is a premonition of a downturn in the market. It looks like we have an inverted yield curve right now, and I just want to get your thoughts on that.
It's not a causal indicator. Every recession has had an inverted yield curve, but not every inverted yield curve has resulted in a recession. So the recession, the sort of general definition of recession is 2 consecutive quarters of negative GDP growth. But there's more that goes. So I think just based on that very rough definition, it seems very highly likely that we will go through that with interest rates where they are. The banks recently, that is with Silicon Valley Bank, Signature Bank, First Republic Bank kind of struggling. That's going to result in less lending. So that will also help slow things down, which is a good thing. But the other, when blanking on the name of the bureau, the EDC, that actually determines what an actual recession is, and this could be 18 months after the recession occurs. There's more to it than just, because that's the way, data works. There's a lot more to it than the yield curve, which I don't even think is technically what they look at. But it's a lot more than just GDP growth. It is jobs. And so that's the one variable that is such a big unknown, because the job market, notwithstanding every day we see Facebook's laying off 7,000 people, Disney's laying off 7,000. Of course we're seeing those headlines, but the job market is so strong. Unemployment is still at, record lows. It's like 3.5%. And so I don't think there'll be a technical recession unless you see the job market actually starting to slow, which it probably will as there's less money sloshing around the economy, as lending slows down. I think that probably will pick up, but I think the yield curve is like the least reliable indicator of whether or not we're going to see a recession.
Just a follow-up on that, since you mentioned it, the banking situation and commercial real estate, and rumors that the banking sector may have a really tough time coming up.
Yeah, luckily, yes, absolutely. So the regional and community banks supply like 70% of commercial real estate lending. You might think it's JP Morgan, but it's really not. It's really these small community banks that are providing lending for these commercial real estate loans. So it's going to be ugly. You have basically no exposure. You will get a little bit through the Andros real asset portfolio, but it's not going to be office properties. We're not investing in managers, and that's where you're going to get the biggest write-downs is big Class A, Class B office properties in the big, metro areas. So your portfolio really, we used to have REITs, maybe people remember that, commercial or real estate investment trust. That's where you're gonna see a lot of that hit. That's public equity invested in commercial real estate. We're not invested, you may have a little bit through some of your managers because it's in the benchmark, but we even have a slide, I think you're underweight. But it's gonna be ugly. I think the commercial real estate market is gonna be ugly, which, I'm always thinking glass half full. That's going to provide a lot of opportunity. And your managers that are investing in private real estate will be able to exploit that opportunity because they have locked up capital and can invest in properties that have gotten super cheap and beaten down because of the environment. But yeah, commercial real estate is going to be definitely troubled in this upcoming environment.
Linda, do you have any questions in the chat that we want to highlight from folks on Zoom, or?
No.
Okay. There's a little number that says like 24, and so there's a mild panic that lays in when I see a number that high. You had a question in the back.
You mentioned that what would you say outside of market are some other?
Big one's going to be, we used to have a slide and I was going to move to it. The big two are going to be GDP growth and jobs. There's a slide that we went through with the investment committee that showed for all of like the last 6 recessions, how those indicators look relative to equity markets. And actually equity markets, so think the S&P 500, actually hits a bottom 6 to sometimes 12 months before you see the trough, the bottom, in those economic indicators. So I think that's another sort of good news possibility. The job market and GDP may bottom in 6 to 12 months, but we may have already hit maybe the bottom, maybe a little bit more from an equity market perspective. So that's another thing. You usually see economic fundamentals trail the equity markets by 6 to 12 months. But yeah, I think jobs, there's so many different data stats, new homes, new construction, commercial real estate. There's tons of economic data that will all factor into it, but I do think the job market is going to be really the big one because that's the one that's just so solid right now and kind of just a head scratcher. How do we slow the environment down if everybody is working and can still go out and spend all this money? Then we're not going to be able to bring money supply down. We're not going to be able to get inflation under control. Inflation is still 6%. That's really high, as we all know. Every time you go to the grocery store, you're like, how is this possible? So we need to get that under control, and it'll probably take a little bit of pain, hopefully short term. But if we don't, we're kind of looking at that forever, and we can't have that. So the Fed is, admittedly late to realizing inflation got out of control because there was $2 trillion of government aid that was, thrown at the economy during the COVID relief period that it was too much money moving around and too much growth, money supply rocketed up, and that was the consequence, was that out of control inflation.
I think an important concept to highlight with this question of like, is there a recession coming? What's the market going to do? Is for folks who are here with agency funds or org funds, is to meet with your board and have that conversation of like, what is your risk tolerance? Like, what is the purpose of your fund, and like, what is your time horizon? How long do you want to have the funds here? Are you treating this as an investment vehicle? Are you treating this as an endowment fund? And like, what are the purposes of it? And Laurel and I would be happy to meet with you and discuss that as well. And then for folks who have donor advised funds, right? What does it mean for your charitable purposes in the community to see those fund balances go down, right? I think that's a really important question to ask yourself and to reflect upon it of like, what are the purposes of these funds here, right? Like, these aren't our retirement accounts for, you know, donor advised funds. For agency funds, they might be. I don't know what you're putting in these funds. Those are your funds. But for folks who have donor advised funds here, or who have designated funds that are annual payout funds or scholarship funds, you know, thinking really big picture of like, what does it mean when my fund balance goes down? What is the charitable purpose of this fund? Why do I have it here? And having that conversation with yourselves and then with Laurel and I to make sure that, you know, you're in the right pool, you have the right risk volatility ratios, you have the right mindset of how those funds are going to be used. I think this is probably the last question because we're close on time, right?
We're scheduled till 12, so we actually have plenty of time.
Oh, we have plenty of time.
Yeah.
Quick question.
Yeah.
Maybe it's up to the donors themselves, but is there any indexing for inflation on the payout of these funds? This one just brings up that point to mind because it's $1,000, which is, I'm sure, a lot different than at the time it was started in its buying power. How does the organization handle that aspect of things to make sure that they're still relevant of themselves?
I think both. It is to some extent up to the donor, depending on the type of the fund. So for a scholarship fund like this one, where both of the donors are no longer advising the fund in any way, our staff could, if it was a fund where they had said make $1,000 scholarship, but the TSP payout rate could allow for support more than that, our staff could decide to have it be higher. Or if they had originally said make 2 $500 awards, our staff could decide, you know, now we want to make that $1,000 one to make it more relevant to today's dollars. With other types of funds, it's mostly the donor's decision, because they set, you know, if it's a designated fund, they would set the organization they want to support and how much, if it's a flat amount, but the TSP also is what controls a lot of that as well. So if it's an endowed fund, that amount is always going to be set by the TSP, but we could do things like if it's a designated fund that supports 6 different organizations, maybe we would talk to the donor about reducing the number of organizations so that each one could have a larger portion of the TSP. So there's just different ways that we can work with donors, or when there are no donors, with our staff to address.
We've had this conversation in the past too, where inflation is kind of baked into the return hurdle over the long term, right? So it's kind of baked into that calculation that we have of saying like our long-term return hurdle is, you know, 8.25%, and inflation's baked into there. In the immediate short term, no, unfortunately not, right? Because we take things in such long looks, we take things in such long chunks. And we even do the 16 trailing quarters, right? Of like how long we take those balances and calculate them over. So, you know, immediate ability to react is fairly limited. The one time we have done something different was in relation to COVID-19, right? Where we actually raised the annual payout rate to 5%. In that like one instance, you know, I don't get to make that decision. I just get to propose things to the committee. And so we'll see what the committee has to say at the finance committee meeting.
Any other questions?
The federal government now is discussing increasing the national debt limit, as it should run out here within days, months, whatever it is. If they can't come to an agreement and it sticks right where it is that going to bother this kind of investment into the future?
Typically, does not really impact the stock market. I mean, usually the government goes to the 11th and a half hour and comes up with something, and the stock market usually kind of shrugs that off. This happens every, what is it, like 3 years or something? So I don't suspect this will be any different. We did have, you know, the S&P downgraded the treasury market at one point, what was that, like, Patrick probably knows, 2016 or something, and even the stock market didn't do anything for that, and that was downgrading our debt from AAA to AA because of all these squabbles, so. Yeah, I mean, there's always gonna be volatility, there's so many unknowns in the world, I would put that on the lower end of what we would worry about.
A question about unemployment. Do they designate who is working and who isn't working? Like what you just said, so many people have been laid off from, the big tech companies.
Yeah.
But we have poor people who are working 3 jobs, they're employed. So is there a way of breaking down that?
There is, so there's the headline unemployment number that I think is 3.5% right now. And then there's I forget the name of it right now, but it includes underemployed, where they wish, or they're trying to get more employment. And that's a lot higher. I don't know the number, I think it's like 5.5% or so. So it's still like record low. These layoffs, they take a while to work through the system as well. So, while Facebook may announce layoffs of, 10,000 people or whatever, a lot of that actually may not come to pass. They lay it off and then, some of it's through attrition, but a lot of it, there's actually an article in the journal that says, these 10,000 person layoffs, when you look at the data 12 months later, it's more like 3,000. So maybe it all won't be as headline alarming as the original headlines are, but yes, there is data that supports, what I was just gonna say is, I think that will make its way through the unemployment and probably bring up unemployment once all these headline things come through, but it's still a very tight job market. I mean, you go to a restaurant, almost every place is like
I guess my
hiring.
question is that the folks who are getting,
Are they counted?
no, people who aren't getting, or just getting living wages compared to people who are employed with, ample salaries. Is that broken down when you talk about employment?
Oh, yeah. The Department of Labor can cut it any which way, and you can go look on their website.
So just generally talking about employment being up or down is sort of vague compared to what we really have.
That's fair, right, yeah. It's including everybody, it's including every different, but you can drill down and see in different, I can follow up and send James something. You can see the trends of different ranges of salary, and they usually track each other, like, they'll be different and there could be higher lower employment and different things, but they still usually follow the track, but I'll send James something, he can. Thank you. Yeah.
Any other questions, or is there anything from online, Linda? Questions from online? Anyone else here have any final questions before we close out? Feel free to follow up with myself or James afterwards as well if you think of something on your drive home or tomorrow. We're happy to follow up with anyone.
And there's lots of scrumptious food,
Yes, please
which we
enjoy.
can't offer the Zoom people, but I hope your fridges at home have. But please, enjoy the food. Thank you, everyone.
Thank you.
Thank you.